Hello and welcome to Dohnatian Investment. This analysis is for Synchrony Financial on the New York Stock Exchange as of 16th of July 2026 with a share price of $74.28. The full report is on dohnatian.ca. Synchrony is a high-return consumer credit franchise trading at under 2 times tangible book, and the medium and long calls are both buy, but the short-term call is hold. Q2 earnings land on 21 July. The tape has not turned, and there is no discounted entry yet. Buy on confirmation after the print or on a pullback into support. The quality here is real. Synchrony earns a return on equity around 19% through the cycle, on card economics that give it a return on assets several times a typical bank, and it runs a very lean 36% efficiency ratio. Yet the shares trade at just under 2 times tangible book, against a warranted multiple of 3 times. That is a ratio of 2/3, squarely in the attractive band. On a clean reserve normalized basis, the trailing price to earnings is about 9 times, cheap for the returns. So why not buy today? The tape is genuinely mixed and the print in a few days dominates the near term. The monthly trend is up, but the weekly is a downtrend. The daily is only recovering, hugging its 200-day average with a negative momentum reading, and volume is soft at 2/3 the 20-day average. The price sits mid-range, a coin flip rather than a confirmed uptrend. There is no volume confirmed breakout, so the technical entry is unmet, and with Q2 earnings inside the window, the timing is a binary event. The stock is cheap, but the entry edge is not there. The driver is the health of the everyday American consumer, and right now it is genuinely contested rather than a headwind. First quarter net charge-offs came in at 5.5%, down almost a full point year-on-year, delinquencies stabilized, and purchase volume hit a record. So credit is normalizing favorably, which is why the driver scores a neutral 50. But it is the unhedged swing factor. The macro report flags a consumer rollover and private credit stress as the live tail. A neutral driver does not amplify, so even with the sector tailwind, this is a plain buy, not a stronger one. The risk here is cyclical, and it is the reason the stock is cheap. The bear case sees the shares fall to about $62, roughly 16% below today. That takes a consumer recession spiking net charge-offs back above 6 or 7%, forcing a large reserve build that craters near-term earnings, while the multiple stays cheap because the market will not pay up for a lender heading into rising losses. On top of that, Synchrony depends on a finite set of large retail partner contracts, and losing one is a step change, not a trickle. It lost the Walmart program to Capital One in 2019, and buy now pay later fintechs are chipping at the point of sale frontier. This is a real risk, not a distant tail. Now weigh the risk against the reward. The bull case is roughly 31% above today, the base case, the most likely, about 14%, and the bear case a fall of about 17%. So you are risking about 17 to make 31. So, our call on Synchrony Financial on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Dohnatian Investment at dohnatian.ca. The link to the full report is in the notes below. Have a great day.